This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au to book an appointment.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to another episode of the Smart Property Investment Show. There's always so much going on in property across Australia, and obviously something that everyone is talking about is the upcoming fixed rate cliff. And CoreLogic actually recently released some research on this. And to unpack it all, I've actually got one of my colleagues from the Smart Property Investment team, journalist Kyle Robbins, with me. Kyle, welcome back to the show. It's not your first rodeo, but good to see you again on here.
Good afternoon, Grace. Yeah, not my first one, probably my fourth rodeo now, so finally getting the hang of it.
Well, I mean, it is a big topic, isn't it? And it's something that we have been in discussions about for a long time now. Obviously, this most recent insight from CoreLogic is not the first that we've heard on the topic, but it's definitely adding to, I guess, a growing list of experts who have weighed in going, yeah, there's something that's going to happen this year. It could be putting a bit of stress into people's minds at the moment.
Yep, it's just another buzzword or a buzz phrase in the property market vocabulary, the old fixed rate cliff.
So what has led up to this then, Kyle, to give a little bit of context? I'm sure everyone knows by now that we've come off the back of, 8-9 consecutive rate rises from the Reserve Bank of Australia from the record low rates in just April last year, which feels weird to say, of 0.1%. We're now above 3%. What's kind of been the background to rates rising and then, this situation that we're seeing now?
Well, obviously, as you said, the rates were at 0.1% April last year. In that time, there's been a lot of economic turmoil. So inflation's gone up. The RBA has gone into inflation saving mode and have decided to raise the cash rate for 9 months now. Prior to that, the cash rate was at a record low. It was at 0.1% for quite a substantial amount of time due to, the pandemic and all the myriad of factors that have plagued Australia for the last couple of years. And off the back of that, borrowers opted into fixing their home loans at a real low rate. That was CoreLogic have said on average about 1.98%, around April 2021. So quite a low interest rate. So they fixed to that rate, to that figure. And now we're getting to the point where those terms are coming to an end. And a lot of people are in for a lot of strife as they get hit with the variable rates, a substantially higher variable rate.
And they're up around 5% now, aren't they? Like really, the lowest ones are now up around 5%. It'd be a huge jump for so many people. And it is funny to think back to that period when we were at that record low interest rate, because we did have Governor Lowe, who heads up the Reserve Bank of Australia, saying, we're not going to look to do anything with rates at all until the back half of 2023, 2024. And hindsight is a wonderful thing. But those were ended up being like the really smart people, when for a lot of people were like, no, stay variable, because it was offering a lower rate at that point in time, thinking that it was going to be lower for longer.
Yeah. And just back to your point on the change, I think CoreLogic have the variable rate for April 2023 predicted at being 5.48%. So people on a previously fixed rate of 1.98% will see their repayments jump from just under $2,000 per month to slightly above $3,000 per month. So it's like a substantial increase to their pockets, their hip pockets.
Yeah, I mean, it is an interesting one. It does go back to that economics 101, doesn't it? In that if you're trying to curb inflation, you make things more expensive. And that's exactly what we're seeing. So it will be interesting. We've heard some mixed thoughts on what the property market will do. A lot of people that do think it's bottomed out as a result of this and, is going to at least stay consistent from here on out, which is probably reassuring for a lot of people who are really, really worried about the value of their property moving forward if they do need to quickly dispose of their assets.
Exactly right. And just on that disposing of the asset point, it's something that CoreLogic covered. It's that equity remains really high in most Australian markets, like because of the housing boom, where prices, went up 15 to 30% depending on where you are. I think, let me just get it up here. The RBA Assistant Governor recently noted that about 0.5% of home loans were in negative equity. And if the house values were to fall a further 10%, the RBA doesn't see that number going any higher than 1%. So people selling their homes will not find themselves in like more financial turmoil. Their equity will cover their debt, outstanding debt.
That's really good to know, actually. And it is actually a much smaller percentage than is probably being hyped by the media. We do hear a lot about, the hype and the clickbait and, everything else that goes on in mainstream media here at Smart Property Investment. And we understand everyone's gripes with all of it. It is one of those things where it's a storm that's being fueled by some of this fear-mongering that's going on.
For sure. And even the term cliff hints at like a substantial drop-off. A cliff's not usually quite small. So, I mean, we're sort of privy to that term as well ourselves, but just, some of the wording and then the underlying figures, they tell a contrasting story. So it's quite interesting to look at that.
Yeah, definitely. Well, we've got plenty more to unpack on this episode of the Smart Property Investment Show. We'll see you on the other side of the break. Welcome back to this episode of the Smart Property Investment Show. I am joined by my colleague in the Smart Property Investment team, journalist Kyle Robbins. Kyle, before the break, we were talking about, what this fixed rate cliff could mean and the media hype around it and, whether it's really going to be the cliff that has been, forecast and foreshadowed by pretty much everyone in the media. And as you said, we have been privy to using the word cliff ourselves, but it's only 1% at max, 1% of mortgage holders that are going to actually be badly affected by this. And that's hopefully reassuring to a lot of listeners who, are probably wondering what the effect is going to be on them. There was only really, a couple of months when people were locking in on that really, really cheap fixed rate. And as we said before, everyone thought they were a bit crazy when they could get variable rates for so much cheaper. But, we've seen variable rates go through the roof since then, and we're about to see a lot of those people that were on fixed rates before now move into the variable rate environment. And what is some of the things that we are going to see, do you think, this year? Keeping in mind that it is only a very small proportion of borrowers who will see extremely negative effects from this.
Yeah, so throwing it back to some more stuff that the RBA produced, their October Financial Stability Report revealed that about 23% of outstanding housing credit is fixed. So that's the proportion that they're expecting to come off towards the end of the year. But I think one thing that it's important to remember is, and one thing that CoreLogic talks about, is that what goes up must come down. So the cash rate for 9 months straight now, pretty much 9 months outside of January, has gone up fairly consistently. And so a lot of people could be bogged down in the idea that it's sort of a never-ending ride and that it'll just keep going up and up and up. But a few of the big four banks earlier this year, and we covered it on IOB and SPI, was that a few of the big four banks have predicted cash rate to ease and then come down. So the Commonwealth Bank have predicted their first cut to the cash rate will occur in November, while NAB said early 2024. But the key is that they're sort of expecting a bit of a plateau prior to those dates. So it's not as if we're going to have another 9 consecutive months of 0.5 or 0.25. There's, as we said, what goes up comes down. And so being on a variable rate might be a short-term, or as CoreLogic said, it's a short-term condition. But the life of the loan is not going to be wrapped up in rising interest rates.
Wow, that's a nice little quote there, Kyle. But that's so true as well. Obviously, you don't go into a mortgage thinking it's going to be you're in it for 3 years. A lot of them now are 25 years, 30 years plus. Mm-hmm. There are going to be highs and lows associated with that, but it does seem more like it's going to be a bit of short-term pain, which for a lot of people, you know, it will add up. We've obviously seen, especially while record low rates were around, so many people had a lot of disposable income, and that's what's led to the inflationary issues and all of that. So, yeah, that's a great point to note, just that what goes up must come down. If you can hold on, it's probably a good thing to be trying to do over the next few months. Contact, you know, your financial planner or your financial advisor, work out how you can be looking at your budget and change things around if you are, you know, feeling the pinch at this point in time. But yeah, I mean, just the fact that the rates are probably going to come down as well will in turn affect what the rates do over the next few years too. So you've got to take all the predictions with a grain of salt. We all, you know, listened to Dr. Lowe when he did say that rates weren't going to go up until the back end of 23, 24, and that's not what has happened. So economic pressures can come from everywhere.
Exactly right.
So this is an interesting one, but can you just reiterate how much some of those loans could be going up? I know you've done a lot of work with, you know, looking just at some of these numbers and the amount that people are now having to pay compared to what they were paying a couple of years ago.
Yep. So I'll reference back to the CoreLogic prediction earlier. So on an average loan size, again, this is only an average loan size of $538,936 on an average home loan taken out in April 2021 at a 1.98% fixed rate. Moving into April 2023 with the interest rate adjusted for 25 basis point in February, which we've seen already, and a 25% basis point increase in March to a variable rate of 5.48%. We'll see monthly repayments rise from just under 2,000 to just over 3,000, but it's important to note that that is just for an average loan size of just under 540,000. So obviously different markets will require a higher loan, and therefore the monthly repayments will be higher in that regard because obviously they're taking more from the bank. So yeah.
And it looks like, Kyle, a lot of this pain won't really hit the back pockets of Australians for a little bit. We've still got a couple of months before we actually start seeing this happen. Well, because really you think about the fact that that first rate rise did occur in May of last year. So it'll be the 1 year term starting to come in there.
Yeah, exactly right. And then APRA at the end of last year, in September of last year, they looked at the non-performing loans, which is generally when a repayment has not been made for 90 days or more. And they found that back in September, just 1% of home loans were 30% beyond their due date. It's important to caveat, though, that this period only covers 2/3 of the cash rate increases to date. So obviously we had November, December, and now February. So CoreLogic is saying that, or predicting that, we won't actually see sudden distress in the housing market for a while. And I think that's something that's been talked about for a long time, and something that people have used against cash rate increases, particularly at the start of this year, is that the delayed effects from, even middle of last year's cash rate increases won't come into effect until around this time this year. So all subsequent cash rate raises, their effects will be delayed even further along the line. So it's definitely something to watch out for more in the medium term, I'd say.
And I love that you brought up APRA there, because obviously mortgage serviceability rates came into question a couple of years back, really, with rates so low. They changed the ceiling on what people needed to be pricing in. So the amount really that are on those loans already, we're getting to the point where those extra payments have already been, factored in by the banks to even let them get a loan in the first place. So that is based on, people's income and their asset bases already. So that's something to also keep in mind, that's going to, keep that floor in there. A lot of people, yes, are going to struggle a bit more, but we're not going to see this, complete crash of people who all of a sudden really can't pay their loans.
And this is obviously the objective of the RBA's when they started raising the cash rate, is to see people's discretionary spending, I guess, reduce. And I think that's sort of coming to fruition with a rising interest rate and a rising mortgage. People are going to have less disposable income. They're going to have less money to spend on potentially holidays or shopping. stuff like that. And I think that's just another thing to remember, is that this is all part of, I guess, the key objective started early last year.
Still more to unpack. I mean, we could be talking about finance forever, but that probably wouldn't be fun for anyone. We'll take another break there. We'll be back in just a moment with more from the Smart Property Investment Show. Welcome back to this episode of the Smart Property Investment Show. Before I let Kyle go, I've actually nabbed his notes, what he's been reading off, some of the stats and figures today. And there's one thing that I wouldn't mind bringing up with you, Kyle, and super interesting, something that was brought up in the CoreLogic research about the fixed rate cliff, and that's what we're talking about today. And that's that variable borrowing has a lot to teach us. And that's a really interesting comment, I think, because obviously we're talking about the fixed rate environment. So to then bring it back and be like, well, what does that teach us about variable borrowing is an interesting one, but definitely some valuable insight there. Talk us through that.
Yeah, so basically what it looks at is the RBA's February statement of monetary policy, which found that 7 out of 10 outstanding mortgages were on a variable rate.
Which is a lot. It's far more than the amount of people that are currently have their mortgages on a fixed rate.
Of course, and what CoreLogic have said is that the majority of the outstanding mortgage debt has already been subject to steep rate rises. So I guess what the variable borrowing perhaps is teaching us is that there is resilience in mortgage households, in the sense that they've been able to ride this oncoming cash rate tide with relative, I'll use that word again, resilience, in the fact that we haven't seen as many arrears as, maybe it was forecast when this cycle intensified during the middle to back end of last year.
Yeah, no, it is really cool because, that means that 7 out of 10 mortgage holders in Australia, and that's looking across the spectrum of owner-occupiers to investors and everything in between, are going okay. They've already had to deal with this fixed rate cliff that we're about to see. They've dealt with that every step of the way, and each time that it has gone up. Maybe it's a little bit of a softer blow is probably a fair statement to make, but to see that, we're not seeing a lot of distressed sales on the market yet, which means that these people are coping and are happy to still be paying their mortgage month to month at these rates.
It is very interesting, and it's probably something for, if people are on a fixed rate, to take a little bit of hope from, is that there's this many households on a variable rate that have managed to survive. So there's obviously ways to do it, and there's no need to be disheartened every first Tuesday of every month.
Another point to bring up, Kyle, is just around redraw and offset accounts, which were very much in use while we saw rates at record lows. A lot of people took the opportunity to be paying off more of their mortgage. Do you think that's something that is holding people in good stead at the moment when it is getting a little bit tougher?
I think so. I think when you look at the data, which indicates that at the moment, nationally, borrowers are dedicating about 15.7% of their housing payments to an offset and redraw account.
Which is lower than it used to be pre-COVID. But, I mean, we've seen the rise and the fall of that as well. We saw so many people using and putting money into their offset and redraw accounts during the record low interest rate period. So that probably did hold people in good stead, but that easing back now, because what was it? Up around 20%, wasn't it?
Yeah.
Pre-COVID. So it's gone up, it's gone back down, and that's to do with that feeling the pinch, really. But people took advantage while they could. And I guess it's all part of the property market cycle, isn't it, Kyle? Things go up and they go down. And it probably, if it's your first time going through this, plenty of people have done it before, and I'm sure it will all be happening again. So they're all lessons really in the end, aren't they, Kyle?
Exactly right. Every roadblock is a lesson.
Kyle, before I let you go, thanks so much for sharing some insight into that CoreLogic research. Really, really interesting stuff there from Eliza Owen. We'll have to get her back on the show at some point again, because she's always got some great commentary, and I think just calms everyone down a bit, provides a bit of reassurance about what everything actually means. But before I let you go, Kyle, what else have we been seeing lately in the property market? What's going on?
That's a great question. Let me try to refresh my memory. What have we been seeing? I guess obviously there was a lot of stuff at the start of this month about the cash rate. It's an interesting one. I think we've seen a lot of news come in recently about areas and markets that sort of need investors, or areas and markets that are primed for growth, this kind of thing. I think there was something about HIA predicting house building will be at its lowest point in the decade next year.
It all comes back to that rental crisis, doesn't it? A very permeating theme. I mean, it's especially pertinent with the New South Wales election coming up. There's a lot of talk already, not only about housing affordability, but what the government that is elected will do to lessen the rental crisis, which is showing no signs of abating in New South Wales at the moment. We're still seeing people literally being pushed out of those more metro areas into the regions, which are also suffering because they've all got very low vacancy rates as well. It's a nationwide trend, though. It's not something that we can say is just happening in New South Wales.
No, vacancy rates are down all across the country. It's quite alarming, really, when you think about it, especially with, as we've done a bit of coverage on, influx of international students coming in for the start of semester and increased migration. So more strain will be placed on the housing market and more people will feel a lot of pressure and a lot of stress as a result.
We're starting to see some real solutions be offered to alleviate some of these issues. You know, they surround land tax breaks, that change to stamp duty, which has been an ongoing topic for years now, really for decades, but we won't go back that far. It'll be interesting to see, I think, this year, Kyle, how some of that discourse actually develops, because we're at that crisis point already and things are only going to get worse. And so we need, new ideas, new voices to be coming out, which can actually affect change. It's one thing to be talking about it, but it's an entirely different thing to actually be putting things in place to fix this.
Exactly right. Actions speak louder than words, as they say.
And it's something that I know that you love covering, even down to some of that, flood coverage that you've been doing over the last couple of months, because that in turn is only exacerbating some of these issues, isn't it?
Exactly right. People in flood affected areas are maybe a little bit more reluctant to return to those areas, and therefore heading into already strained markets. And, there's just a whole myriad of issues that's, we still haven't yet seen the full effect of.
Plenty more to unpack, and I'll have to get Kyle back on for another episode of the show down the track. In the meantime, keep checking out his articles on smartpropertyinvestment.com.au. Kyle, thanks so much for your time today.
Thanks for having me.
To everyone who is listening along, we hope you have enjoyed this episode. Like or review us on whatever platform that you do listen to your podcast on. If you have any questions, don't hesitate to reach out, editor@smartpropertyinvestment.com.au. Stay up to date with us on our social media, Facebook, Twitter, LinkedIn, and Instagram. Until next episode, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Have you signed up to HR Leader? Go to hrleader.com.au to subscribe. Receive the latest HR and people leadership insights and news.